Silver isn't going up. Your money is quietly losing control. That's the contradiction nobody is preparing you for. Headlines frame this as a metals rally, another swing in a familiar cycle, but the evidence points somewhere else. This move isn't being driven by hype, it's being driven by dilution. And if that's true, this isn't just about traders or investors. It reaches straight into your savings, your wages, and the price you pay for everyday things. Since 2020, the money supply expanded by roughly 40%. That's not an opinion, that's arithmetic. More currency units chasing the same finite assets. In past cycles, prices spiked and then fell back. This time, markets aren't overshooting. They're recalibrating. When new price levels form under those conditions, history shows they don't simply unwind. Here's where the story flips. Silver is no longer acting like a hedge you trade in and out of. It's starting to behave like a scarce industrial input in a system that can't print more of it. And when that reality collides with supply limits, sovereign debt stress, and geopolitics, the consequences accelerate fast. What's happening now didn't start with silver. Silver is just where the pressure becomes visible. The core event looks simple on the surface. Prices are rising, volumes are increasing, and attention is coming back into precious metals. But that's only about 60% of the picture. The more important part is what changed underneath. This move is happening at the same time governments are issuing record levels of debt, central banks are trapped by inflation, and industrial demand is quietly absorbing physical supply. Those things don't usually line up at once. This time they are. Notice the pattern. This isn't isolated to one country or one market. Gold is holding higher levels instead of crashing back down. Silver is moving faster than gold. Bond yields in major economies are becoming unstable. Trade relationships are fracturing. These aren't random data points. They're signals of a system under strain, adjusting in real time. Here's the question most coverage avoids asking. If prices aren't rising because of speculation, and they aren't rising because of temporary fear, what exactly are they responding to? Because markets don't reprice everything at once unless something structural is forcing them to. And once that kind of repricing begins, it doesn't stop politely. The claim is simple but uncomfortable. This market is no longer being set by paper price discovery. It's being dragged by physical reality. Here's the concrete detail that forces that conclusion. Roughly 75% of global silver production now comes from byproduct mining, not primary silver mines. Byproducts pulled out while mining something else, and the grades are deteriorating. Typical yields are struggling to reach 100 grams per ton. That means exponentially more rock has to be moved, crushed, processed, and financed just to get the same ounce of metal. Now contrast that with what actually counts as exceptional today. Intercepts of 467 grams per ton over 15 meters. Veins running above 300 grams per ton across meaningful widths. Those aren't normal deposits, they're geological outliers, and the fact that they stand out tells you everything about how scarce high-quality supply has become. But notice what's missing from the mainstream conversation. There's no quick fix here. You can't flip a switch and increase silver output. Most of the easy silver was mined decades ago when prices were suppressed and exploration budgets were cut. Those decisions locked in today's shortage years in advance. This is where the story quietly changes. Silver isn't scarce because demand suddenly spiked. It's scarce because supply was structurally neglected when no one was paying attention. And that imbalance doesn't correct gently. What happens next is escalation through normalization. As prices rise, the system starts treating abnormal conditions as routine. Ore grades fall, costs rise, timelines stretch, and instead of triggering alarms, the market shrugs and adjusts the price higher. This has happened before, but never with this many constraints layered on top of each other at once. There's a precedent here, but it's not the one people usually cite. This doesn't resemble the 1980s spike driven by concentrated speculation. That episode burned hot and collapsed because the underlying system was intact. Supply existed, currency stability existed, confidence existed. Today, none of those assumptions hold. What's happening now looks more like slow motion rationing than a blow off top. Notice how quickly this becomes normalized. Mining lower grades becomes the new standard. Higher costs become the new baseline. Delays become expected. When an entire industry quietly accepts worse conditions as normal, prices don't mean what they used to. They stop being signals and start being accommodations. Here's why that matters. Once markets accept scarcity as permanent, they stop pricing for cycles and start pricing for continuity. That's when volatility shifts direction. Instead of spikes followed by collapses, you get stair steps higher, each one defended harder than the last. This is the point where people keep waiting for a pullback that never fully arrives. And right as that realization spreads, the next contradiction appears. Here's where the evidence gets harder to ignore, because the words and the actions stop lining up. Officially, silver is still treated like a volatile commodity, something cyclical, something speculative. But look at what's actually happening in the physical market. Silver isn't being stockpiled the way gold is. It's being consumed. Electronics, energy systems, industrial components. Once it's used, it doesn't come back. That alone changes the math. Now add the ratio. Historically, silver traded at about 4 to 6% of gold's value. Today, it's closer to 1.5%. That compression isn't a sign of balance. It's a sign of distortion. Either gold is wildly mispriced or silver is being held down relative to its role in the real economy. Both cannot be true at the same time. And notice the contradiction. The system talks as if silver is abundant, but it behaves as if it's scarce. High-grade primary deposits are rare. Byproduct supply can't respond to price. Industrial demand doesn't wait for corrections. Those realities don't match the language used to describe the market. This is the line that changes how you see it. When a material is essential, consumed, and slow to replace, price stops being a trading signal and starts becoming a rationing mechanism. And once price starts rationing access, pressure doesn't release. It migrates. Now the pressure starts stacking faster than the system can absorb it. At the same time silver is being pulled into industrial use, stress is spreading through places that normally stay quiet. Bond markets begin to move in ways they're not supposed to. Long-term yields jump instead of drift. Central banks hesitate instead of stepping in cleanly. Liquidity thins, not because demand disappears, but because no one wants to be the one caught holding risk when confidence shifts. Watch the speed here. One market tightens, another reacts, a third starts repricing in anticipation. There's no single headline moment, it's a compression event. Everything starts leaning at once. When that happens, control becomes reactive instead of deliberate. And this is where the loss of optionality matters. Policymakers can't raise rates aggressively without breaking debt markets. They can't print freely without feeding inflation. They can't slow demand without hitting growth. Every lever pulls against another lever. That's not stability. That's constraint. Here's the uncomfortable question hiding underneath all of this. What happens when a system built on flexibility runs out of room to maneuver? Because when pressure keeps stacking and no release valve works the way it used to, something else gives instead. And that's where the consequences stop being abstract. What happens if this continues? This is where it stops being theoretical and starts showing up in your daily life. You don't experience systemic stress as a chart. You experience it as friction. Prices that don't come back down. Paychecks that don't stretch the way they used to. Products quietly changing quality, size, or availability. When materials like silver become constrained, the effects don't stay inside commodity markets. They bleed outward. Electronics cost more to build. Energy systems become more expensive to maintain. Infrastructure upgrades get delayed or scaled back. Companies don't announce this as a crisis. They adjust quietly. A surcharge here, a delay there, fewer options, less redundancy. You feel it as waiting longer, paying more, and getting less explanation. Notice how this bypasses ideology. It doesn't matter what you believe about markets or policy. Scarcity expresses itself the same way every time. It raises the floor under costs and removes flexibility from everyone downstream. Households adjust last, after institutions and corporations have already locked in their margins. If this feels familiar, say so in the comments. Most people sense something is off long before it shows up in official data. And once enough people feel it at the same time, the story stops being about prices. It becomes about control. Here's the part that mainstream coverage almost never slows down enough to explain. This doesn't happen because of a single bad decision. It happens because of incentives. Systems don't break when people panic. They break when everyone follows the rules at the same time. Governments issue debt because they must. Central banks support markets because they're mandated to. Corporations secure materials because production can't stop. None of those actions are irrational on their own, but together they create a feedback loop. Debt issuance requires low rates. Low rates weaken currency. Weaker currency pushes real assets higher. Higher real asset prices force institutions to secure supply earlier and more aggressively. That behavior tightens markets even more. Scarcity becomes self-reinforcing, not because of fear, but because of compliance. This is why spectacle matters. Public focus stays on elections, personalities, and short-term drama, while the real mechanisms operate quietly underneath. By the time headlines catch up, the system has already adjusted. Not explosively, permanently. Here's the unsettling insight. Power in this environment doesn't belong to whoever predicts prices best. It belongs to whoever secures access earliest. When systems move from abundance to constraint, price becomes secondary to availability. And once access starts mattering more than price, the next phase is already in motion. From here, the path forward splits, and neither option is clean. In one scenario, pressure keeps building quietly, prices grind higher, volatility spikes, then settles at a new range. Governments step in selectively, not to reverse the move, but to manage it. Access gets prioritized, certain industries are protected, certain costs are absorbed or hidden. On the surface, it looks like stabilization. Underneath, flexibility keeps shrinking. The system holds, but only by hardening. In the other scenario, something external accelerates the timeline. A debt market breaks discipline. A currency defense fails. A trade dispute turns into a supply shock. Not a collapse, but a lurch. When that happens, repricing stops being gradual. It becomes urgent. Institutions move first. Households react last. By the time it feels obvious, the adjustment has already happened. Notice what both paths share. There's no return to the old baseline. The question isn't whether prices fall back, it's whether access stays broad or becomes tiered, whether adjustment stays slow enough to manage or fast enough to force intervention. And here's the part to watch closely. The next move won't be announced. It will show up indirectly in policy language, procurement decisions, and quiet rule changes. When you see those signals line up, you'll know the direction is set. Here's the insight that ties all of this together. What looks like a story about silver is actually a story about systems losing slack. When money expands faster than reality, when supply is slow and demand is non-negotiable, markets stop behaving like cycles and start behaving like constraints. Prices don't signal opportunity anymore, they signal priority. That's the shift most people miss. This isn't about timing a trade. It's about recognizing when the rules underneath the game change. When access quietly starts to matter more than price, the adjustment is already underway. Silver just happens to be where that stress is becoming visible first. The question now isn't whether this trend reverses, it's where the next pressure point surfaces when it doesn't. Because once one constraint locks in, others follow. If you want to stay ahead of that curve and understand what's forming before it becomes obvious, make sure you're subscribed. This story isn't ending here, it's only moving to the next layer.